For most of the modern financial system, one assumption has quietly held everything together. That when the United States borrows money, the world will always be there to lend it. Not out of loyalty, and not out of trust, but because there has never been a better alternative. That assumption has shaped interest rates, currencies, housing markets, pensions, and global trade for decades. It is the invisible foundation beneath the global economy. And for a very long time, it was rarely questioned. But that assumption is now being challenged more openly than at any point in recent history. This pressure is not abstract. It intensified when US geopolitical actions and threats forced European governments to re-evaluate trust and reassess economic risk all at once. Europe is reassessing how dependent it really is on the US financial system. Japan is caught between currency defense and debt sustainability. China continues a long, quiet strategy of diversification. And investors, both public and private, are beginning to talk openly about risks that were once considered unthinkable. This is no longer an abstract debate. In recent weeks, European institutional investors have publicly discussed reducing exposure to US assets. A Danish pension fund announced plans to divest roughly $100 million of US Treasury holdings, citing concerns over political risk and fiscal trajectory. In global terms, that amount is small. But the signal is not. Pension funds are among the most conservative actors in the financial system. When they begin to speak openly about reassessing US government debt, it reflects a deeper shift in how risk is being perceived. At the same time, geopolitical tensions have intensified. Discussions at major international forums have underscored how fractured the global order has become. Security guarantees, trade relationships, and territorial issues are no longer treated as separate from financial exposure. They are increasingly intertwined. Countries are thinking not only about economic returns, but about leverage, vulnerability, and dependence. And when finance becomes strategic, the assumptions that once underpinned stability start to erode. The question many people are now asking is simple, but uncomfortable. What happens if the largest holders of US government debt stop buying, or begin reducing exposure? Could that trigger a broader sell-off? Could it push the United States into crisis? And if the US economy were to stumble, would Europe, Japan, and China fall like dominoes? To answer those questions properly, we need to move past headlines and fear, and look carefully at how the system actually works. Who owns US Treasuries? Why they hold them? What selling really means? And where the real risks actually lie. The United States currently has more than $30 trillion in outstanding federal debt. That number alone often fuels alarm. But the structure of ownership matters more than the headline figure. Roughly two-thirds of that debt is held domestically, by US pension funds, insurance companies, banks, households, and government trust funds. The remaining third is held by foreign investors. Among those foreign holders, three stand out. Japan is the single largest foreign holder of US Treasuries. Europe, taken collectively through central banks, sovereign funds, and institutions, represents another major share. China, while no longer the largest holder, still owns a substantial amount. These holdings exist for practical reasons. US Treasuries are liquid, widely accepted as collateral, and deeply embedded in the plumbing of the global financial system. They are used to settle trades, secure funding, and manage currency reserves. They are not held out of goodwill or political alignment. They are held because, for decades, they offered stability in a world where alternatives were limited or riskier. But that calculus is changing. We have seen shifts in Treasury demand before. In the 1930s, global debt deflation and collapsing trade flows destabilized financial systems worldwide. Governments struggled not because they lacked assets, but because confidence evaporated and capital retreated. In 1971, the United States abandoned the gold standard, breaking the last formal link between the dollar and a physical anchor. That decision reshaped the global monetary system overnight, but it also placed enormous trust in the credibility of US institutions. In the late 1970s, inflation and political uncertainty pushed Treasury yields sharply higher as investors demanded compensation for eroding purchasing power. In 2008, foreign demand for Treasuries surged as private markets froze, while the Federal Reserve stepped in as a buyer of last resort on an unprecedented scale. Each of those moments shared a common feature. The system did not collapse. It adjusted. And the adjustment always came through prices, not proclamations. What makes the current moment different is not the size of US debt alone, but the alignment of pressures across multiple major holders at the same time, under conditions of geopolitical strain. Europe, Japan, and China are not coordinating their actions. But they are responding to constraints that are becoming increasingly difficult to ignore. Europe's position illustrates this clearly. European governments and institutions do not hold US Treasuries as speculative investments. They hold them as reserves, liquidity buffers, and tools for currency management. But in specific cases, geopolitics can override purely financial logic. At the same time, political relations with the United States have become more transactional and less predictable. Security commitments, trade policy, and territorial questions are increasingly framed in terms of leverage rather than partnership. When allies begin to question how reliable long-standing arrangements are, financial exposure stops being neutral. It becomes a variable to manage. This does not mean Europe is about to dump US Treasuries. Doing so aggressively would be economically irrational. Selling large quantities of treasuries would push yields higher, tighten global financial conditions, and likely strengthen the dollar in the short term. That would raise borrowing costs in Europe, pressure European currencies, and slow already fragile growth. In other words, Europe would be hurting itself. But the risk does not come from dramatic action. It comes from marginal change. Reduced buying at auctions. Slower rollover of maturing bonds. Incremental diversification. Public signaling that exposure is being reassessed. In markets of this size, the margin is where pressure builds. And pressure, when sustained, changes outcomes. Japan's situation is even more constrained. Japan has one of the highest public debt ratios in the world, sustained for decades by extremely low interest rates. Japanese institutions have long held US Treasuries because domestic bonds offered little or no yield. Foreign bonds filled that gap. But that trade only works if currency stability can be maintained. When the yen weakens sharply, holding foreign assets becomes riskier. Hedging costs rise. Political pressure increases. Domestic inflation becomes harder to control. Policymakers face a narrow corridor. Raise interest rates too much, and government debt servicing becomes more expensive, threatening financial stability. Keep rates too low, and the currency weakens further, raising import costs and public discontent. If Japanese institutions reduce treasury purchases, not because they want to but because domestic stability demands it, the impact is not a sudden shock. It is persistent pressure. A steady reduction in demand that forces yields to adjust over time. This is why Japan matters so much in discussions of US debt. Not because it might sell suddenly, but because its ability to keep buying is constrained. China's role is different again. China has been reducing its treasury holdings gradually for years. This process has been slow, deliberate, and largely unannounced. The motivation is not immediate financial stress, but strategic diversification. Policymakers have sought to reduce reliance on dollar-denominated assets, increase flexibility, and hold reserves in forms less vulnerable to geopolitical pressure. This is not about making a statement. It is about optionality. But even gradual selling matters. When a large holder steadily reduces exposure, the market must absorb that supply. And absorption happens through price. This is where many public discussions go off track. Selling treasuries does not mean the United States runs out of money. It does not mean debt holders can suddenly demand repayment. US treasuries are fixed instruments. They pay out on schedule. Holders cannot call them early. If the United States failed to pay interest or principal when due, that would be a default. And a US default would not be a bargaining tactic. It would be a systemic event. If the US were to ignore its debt obligations, global financial markets would freeze. The dollar's role as the world's reserve currency would be called into question. Collateral chains would break. Banks, pension funds, and insurers worldwide would face immediate losses. Trade finance would seize up. This is not speculation. It is mechanical. That is why default threats are not credible in practice, regardless of political rhetoric. What selling treasuries actually does is adjust prices. When treasuries are sold, prices fall. When prices fall, yields rise. Higher yields increase borrowing costs across the entire economy. Mortgages become more expensive. Corporate financing tightens. Government debt servicing costs rise. Asset valuations adjust downward. This is how pressure is transmitted, quietly and predictably. The Treasury market itself is more complex than most people realize. New debt is issued through regular auctions. Primary dealers are obligated to bid and absorb supply. They distribute that supply through repo markets, institutional portfolios, and global financial plumbing. If foreign demand weakens, auctions do not suddenly fail. Instead, dealers demand higher yields to compensate for holding more inventory. Those yields ripple outward. Because US Treasuries sit at the center of the global financial system, higher yields do not stay contained within the United States. They tighten conditions worldwide. Emerging markets face higher borrowing costs. Capital flows shift toward perceived safety. Risk assets reprice. Countries that borrow in dollars feel this first, as servicing costs rise and currencies come under pressure. Central banks abroad are often forced to choose between defending their currencies and supporting growth. This is how stress spreads in modern systems. Not through dramatic collapse, but through cumulative tightening. Recent geopolitical developments have sharpened these dynamics. Discussions among policymakers have made clear that financial exposure is increasingly viewed as leverage. Control over trade routes, strategic territories, and resources now intersects with capital flows and reserve management. When trust between major economies weakens, even temporarily, financial decisions are reconsidered. Not out of ideology, but out of risk management. This has led to a rise in anxiety-driven narratives. Claims that Europe could collapse the US economy by selling treasuries. Claims that the United States could refuse to pay its debts. Claims that a single action could trigger a new Great Depression. These narratives gain traction because they tap into fear. But they misunderstand how the system works. Europe selling treasuries aggressively would harm Europe. Japan selling aggressively would destabilize its own financial system. China selling aggressively would devalue its remaining holdings and strengthen the dollar, hurting its export competitiveness. None of these actors benefit from sudden action. That is why change happens slowly. But slow change does not mean no change. What is shifting is the cost of capital and the assumptions built into it. The era of effortless financing at ultra-low rates may be ending. Borrowing will still be possible, but it will be less forgiving. Markets will demand higher compensation for risk. Governments will face harder trade-offs. Asset prices will need to adjust. For investors and observers, the signals that matter are not dramatic headlines. They are auction demand, yield curve behavior, currency volatility, and central bank communication. These indicators show whether pressure is building or easing. Fear comes from not understanding the mechanism. Understanding restores proportion. The idea that Europe, Japan, or China might reduce exposure to US Treasuries is not a prediction. It is already happening at the margins. The real risk is not that the system collapses overnight. It is that people react to incomplete narratives and underestimate how interconnected the system is. In a world where geopolitics and finance are increasingly intertwined, understanding the mechanics is not optional. It is the advantage.